What's up, Gould Miners? Today we welcome to the show Julian Vogel, the managing partner at Colony Hills Capital, a family office and fund that specializes in multifamily investments. For a good portion of this episode, I geek out with Julian as we explore the way that he structures his funds and his deals. It is a very unique structure, and so we spend quite a bit of time nerding out and diving deep into the way in which he structured his funds and his deals. Later on in the episode, we cover some of the markets that Julian is currently investing in and why he's chosen to invest in some pretty contrarian markets. And lastly, Julian uncovers the three variables that he considers when underwriting and analyzing a deal before investing in it, and how you can use these same variables when analyzing any investment opportunity. This is a short episode, miners, but it really packs a punch. So without further ado, let's welcome to the show, Julian Vogel. Julian, welcome to the Gold Mine.
Thanks for having me.
Yeah, man. You know, like I said, I've been following your stuff for a little bit of time now, and I know we've been trying to get this thing on the calendar for quite some time. So I'm glad that we could finally make it happen. I know that you started out as a broker. Yes,
mortgage and equity broker. Yeah, that's right.
Right. So you started off as a mortgage broker. So, but what inspired you to make the transition right out of brokering debt into doing multifamily syndications?
So firstly, being a broker is feast or famine, right? You eat what you kill. We live off commission. So I had years where it was amazing. And then I had years where, right, real estate's a cycle where it ebbed and flowed. And I got a wife and 3 kids. So I kind of got a little bit tired of the ups and downs of commission-based compensation, and not only did I want to be on the sponsor side of the equation just so I could learn more, gain more experience in real estate in general. But I also, to be honest, I just wanted the consistent sort of salary-based position. So it's sort of the stars aligned at the right time when I moved back to Western Massachusetts from Manhattan and connected with Colony Hills Capital, and was able to bring, at that time, 6 years of experience in solely commercial mortgage and equity brokering, which I had done for a top 15 firm. I'd done it for on my own as my own business, et cetera. So was able to bring all that experience to the table.
That's awesome, man. So what brought you from Manhattan into, was it just the family life and everything?
Family,
so like what kind of,
Manhattan is not a place where I felt great pushing a stroller, down the street and all these fumes and sounds and smells. And I'm from Western Mass, which is, small and lots of grass and space. So it was a good shift. It was a good move.
That's awesome, man. So I'm actually thinking about moving there. I don't know if you know this, I'm in hotels. So, me and my partners, we buy hotels, and we're looking at one right now in Manhattan. It's looking like it's going to be a go. And if that happens, I'm like, dude, this is the perfect excuse for me to go out there. So I'm always curious to hear, great, maybe as a single guy, which I am, but once the stroller comes around, you want to
teach their own. I'd say you could probably hack it as a single, as once you're married, even with one kid, it's doable. But once you get past the first kid, it starts to, unless you're a billionaire, it starts to get a little bit uncomfortable.
Yeah, I can imagine. So, let's talk about the journey to Colony Hill. So obviously you had some experience, right? So it's not like you were coming in, you were green, or you were a rookie. Were you automatically kind of thrust into this managerial position with the fund, or how did that all kind of play out?
So Colony Hills is a family office venture for Glenn Hansen. He's the CEO and the founder. And he started the company to grow his own wealth through multifamily real estate, value add garden style. And when I joined the company, it was a lean team. They were just starting to sort of grow and evolve as a company, sort of shifting away from this small boutique family office venture into more of a institutional, sub-institutional sponsorship, which is, I think, close to or what it is today, right? Colony at this point has done $1.2 billion of total capitalization, 12,000 units. We're about to acquire a 36th deal. And half of that has been in the last 5 years since I've been with the company. And the company's also grown. Like in the last 5 years now, we're 23 people. When I started, it was 6 people. And we're on we just launched our third fund. So when I came on, it was a lean team and I sort of had the elbow room to, do my thing. And also Glenn Hansen is a great leader in that he's an enabler in a good way. He sort of is able to actualize people's strengths and abilities by being your cheerleader and telling them that they can do it as opposed to like, hold up, so that was empowering. And it led to good things.
Yeah, that's fantastic. Actually, I was unaware of the family office component to the fund. I find this very interesting. So I want to stay on this subject for at least a little bit of time, right? So what I've noticed is there's really two distinct types of investment ideologies, I would say, amongst family offices, right? There's some family offices that are very passive, and then some that are like doing more direct kind of investments. And so I'm curious as to because I don't know if has that always been the case in your experience? Is this kind of like a newer thing where family offices are really taking the lead on investments and doing direct stuff as opposed to being more passive? Kind of walk me through what your thoughts are on that, because I find it fascinating.
Yeah. I'll say that my experience with family offices is that every family office is as unique as each person is. And I think a lot of people are looking to raise capital. It makes it simpler and easier to sort of compartmentalize family offices into a category. But the reality is each family office is head by a family and a unique person, and they have their own unique desires and wants.
Yeah.
As opposed to institutions, right? Institutional or private equity or institutional funds oftentimes have the same sort of culture and the same sort of tendencies and the things that they're looking for and want. What I find with family offices is it's like, there's family offices who do co-GP or LP investments, or they're specific to certain industries, or they're totally open-minded and eclectic, or ones that want to do it their own way, meaning they want to be owner-operators. I don't know, I've seen a lot. I'm not saying I've seen it all, but I've seen a lot of different variations. So I don't know if there's a simple answer to your question in that way.
Well, so when it comes to the Colony Hills philosophy, it sounds like you're the GP, right? So you're managing the fund. How are you sourcing the equity for these deals? I'm assuming that some of it's obviously coming from your office, and then the rest you're sourcing from other family offices. Like what's your capital stack look like?
Yeah. So first we got the debt. The debt is usually from Freddie, fixed rate 5-year to 10-year debt. 30-year AMs, 55 to 70% loan to value or loan to purchase. Then we usually have an institutional JV partner who will provide 50 to 90% of the required equity. And when the deal sizes we're doing are 30 million to 100 plus million. And so 50 to 90% of the required equity is coming from that JV partner. And then the remainder, or the GP equity, is coming from a conglomerate of our fund, right? All three of our funds have been co-GP funds where passive investors can sit as an LP in the GP position. Then principals and employees will also invest into that GP. And then depending on the deal size, we'll bring in a family office, or we'll do a syndication to round out the stack. So it's not a simple stack either as far as how we're capitalizing. But basically you got the LP institutional partner and then the GP. And the GP is made up of us, our fund, and whoever else wants the opportunity to invest in a co-GP position.
So that's a really interesting structure, and it's not the first time that I've come across this, where effectively, instead of fundraising, you're fundraising and you're putting all of your fund into the LP position, you're putting it into a co-GP position. What would the advantages be, for someone who's listening at home and maybe they're a retail investor, high net worth individual, and they're looking at different fund structures? What would the advantages of something like that be versus the traditional, you're just going to, you get some pref equity and then, you're in an LP position?
So depending on the sophistication of the investor, if the investor has the wherewithal and ability to due diligence their own deals and just pick and choose the deals that they want, wonderful. They should do that. Most retail investors, high net worth individuals I know, don't have the time or the experience to do that. They'll go into one-off deals because they like the market or they have a good feeling about something about the deal, so they move forward. But in my opinion, most retail investors who are focused on their 9-to-5 job should be invested into a fund with a sponsor that they trust and they believe in, and that has a proven track record, because their money is diversified. Their 100K is spread out over a portfolio as opposed to a direct deal. And then further, if the fund is an attractive investment vehicle such that it gives the investors outsized returns plus diversification, that's a home run. So that's what a co-GP fund does. But even if it's not a co-GP fund, if an investor has the option between a direct deal or a fund, I think most of the time they should go for the fund unless they know what they're doing, and they're able to pick and choose their deals.
You'd probably know more about this than I do, so forgive me if I sound dumb, but I believe that a lot of the depreciation benefits of, a lot of the tax benefits, a lot of depreciation benefits pass through to the LPs, right? So being in a co-GP position, like how does that impact or affect, or like what would some advantages be tax-wise? And are there any disadvantages or things that someone who is participating in that kind of structure would not benefit from?
So I don't think that's a dumb question or point at all. I actually, as I finished my sentence, I had a thought bubble of the only discrepancy really is the tax advantages, right? And I thought to myself, oh, and then that's your question. So the discrepancy is it with the fund. I'll speak to our co-GP fund. The investors still gain access to the depreciation and the tax loss, but they only gain access to the full benefit of it once the fund is fully deployed. If they invest into the fund and we're sitting on $20 million, but we only put $5 million to work into one or two deals, they're only going to get, the benefit of that $5 million, right? The $5 million invested, the depreciation from that $5 million. They have to wait for the full $20 million to be invested to gain full access to the depreciation, the cost seg studies, et cetera. They'll get it eventually, but it's something that as an investor needs to take into consideration, right? If that is the benefit of investing directly into a deal versus a fund, because they gain access to that depreciation almost immediately, because right, their money is fully invested into one deal as opposed to a blind pool or a fund. So it's delayed. It's, I guess, to summarize, it's either immediate benefit or delayed benefit, right? It depends on the person's situation. If the person has a deal they sold, they don't want to do 1031, and they want to gain access to tax loss to reduce their capital gains or neutralize it, then they should probably be investing into a deal right away as opposed to a fund. If they don't have that situation, my recommendation would still be a fund, because eventually they'll get the tax benefits and the diversification, if that makes sense.
Yeah, absolutely. That makes sense. Now, coming back, because I'm actually really curious about this, right? And how you're structuring these deals and everything. So it sounds like the majority of the equity is coming from like a JV partner, and then you are essentially the GP on that. So would the JV be in an LP position, or would they be also in a co-GP position with you guys? So
they are the glorified LP, the JV partner. They're the ones who we're getting promoted off of. When I say promoted off of, I mean, once certain return hurdles are met, we get a disproportionate share of the upside, and they get a lesser disproportionate share, right? They get whatever the inverse would be, unless it's pref equity, right? And pref equity, then the JV partner has a capped upside. They get first preference on the cash flow, but if the deal is a 50 IRR, they only get their 12 to 13%, and the common or the GP equity gets all the upside. Yeah,
that makes a lot of sense. So now I understand the structure a lot better. And what it sounds like to me is that if you're so you have JV partners with deep pockets, and then we're using the fund to kind of fill in the rest, right? The GP portion of the capital stack. And I mean, that makes a lot of sense to me. So, and it also means that, like, from a raising perspective, if you're trying to, raise for the fund, are you mostly targeting retail investors in the fund then? Or are these, is this institutional money? I'm genuinely curious.
Sure. Yeah. So because these funds are smaller relative to the larger institutional LP funds that are 150 million plus, our fund 1 was 20 million, our fund 2 is 25 million, our fund 3 we're targeting 30 million. Most institutions it don't want to stroke a $15 to $20 million check and be majority of the fund vehicle. They want to stroke a $15 to $20 million check and be 5% of the fund or 10% of the fund, right? They don't want to be most of.
Right.
So that sort of precludes a lot of institutions from our fund, even if they like the strategy. And the flip side is, because the fund is only 5% plus or minus of the equity in each deal, we can't raise too much into this strategy, because then we would need a corresponding AUM or portfolio that would be massive. To give you a real-time example of what I'm explaining, Fund 1 was 20 million. It was invested into 7 properties, 380 million worth of real estate. Fund 2 is 25 million. It's invested into 400 million worth of real estate. If we raised $100 million co-GP fund, it'd have to be $1 billion of AUM, right? Which we're not comfortable doing in a 2-year period, because that's the investment period. So because the bucket's not large enough, those institutions aren't interested, which basically restricts us to retail investors, RIAs, crowdfunding platforms, broker dealers, that specialize in the retail space. So that's who's filling up our funds.
I'm just thinking about this, Julian, and like, based on what you're telling me, because this is, I'm not going to lie, I've heard of this before, this type of fund structure, but I haven't really taken a lot of time to think about it. This sounds like a fund structure that could really promote a lot of like win-win situations, because you're probably able to give a much higher rate of return to your LPs.
Correct.
Right.
That's right.
And also, like, to the JV partner, right? The LP, and then also the people in the fund, right? Because usually the GP is making like a crazy equity multiplier, right? If you hit your hurdles, and obviously, like, if you crush it out of the park. So this sounds to me like, if you inverse it, you can find a partner that comes in, they want to stroke a big check, right? And they also want to see that they're being like rewarded for cutting you that big check with, like, pretty generous hurdles, pretty, generous promotes and whatnot, in terms of like what they're getting. And then also on the same side, on the other side with the GPs, with the co-GPs, the retail investors are going to be able to like have their money work for them as well, like in a much bigger way. This is so fascinating. I'm so glad that we did this podcast, just because I'm learning a lot too right now. So I'm like, dude, this is cool, man. This is really awesome.
So a common question I get with this fund is, why are we doing this? Like, why are we giving up whatever percentage of the promoter carried interest on a deal for this fund? Why don't we just go out and raise a more typical, 20 over an 8 LP fund? Well, when I started with Colony, I spent a year knocking on institutions' doors, sitting down with endowments, large PE firms, and then them basically saying to me, hey, I like your track record, I like the strategy, but in the fund space, you're an emerging manager, and we really want to see you on fund 3 or fund 4 with realized returns. So come back to us when you're there, which is like a decade later. So after hearing that for a year, I basically huddled up internally with the principals, and I was like, look, even though this asset type is arguably, no offense to hotels, but the most resilient asset type out there. I mean, Class B multifamily, right, survives almost every storm I can think of. And we have a track record. We're still perceived as being very risky. So with a risky investment, there has to be adjusted returns, right? There has to be juicy returns to cover for that risk. So where can we give investors that from? or promote. That's where the co-GP structure and strategy came from. And then investors really caught on to it. It's not a long-term fix though, because it comes with a lot of complexity from an administrative standpoint, from an accounting standpoint. It's a lot. So for now it's good, but in the long run, we definitely want to move away from it into a more simple vehicle. But for now it's good. It's good to lily pad or leapfrog, from one fund to the next.
Yeah, this is, well, honestly, you and I should talk offline because I'm really curious how you're doing. Because I mean, we're kind of running into the same issue, as emerging fund managers ourselves. 23 hotels in the portfolio, I guess, isn't enough because
nope.
Yeah,
you have to
still want to see.
Think of their decision set. Think of what they have to choose from as these large passive investors. They have the world is their oyster. They could pick anyone they want.
Right. Fascinating. So switching topics now. And by the way, if you are like ever thinking about putting together a fund, like I hope you rewind and listen to that over and over again. There's something there. There's something there. Whether you choose to do anything with it is your decision. So where are you buying properties right now, Julian? Where's like where are the top markets?
So believe it or not, we like New Jersey a lot right now. We also like Southern Connecticut, Delaware, Virginia, Ohio. Ohio is discovered now, but we still like it. We historically were very bullish and owned a lot in the Southeast and Texas. But since COVID, I mean, everyone and their mother is focused on the Southeast and the Sun Belt and Texas. And so, number one, there aren't a ton of good deal opportunities there because there's so many eyes on it. Number two, at least our experience has been that it's been plagued recently by a massive rise in insurance premiums, tax reassessments, and then, a lot of people bought deals using floating rate debt, right? So a lot of those Sunbelt deals are suffering from that. Versus the Northeast has been sort of overlooked. New Jersey in particular has been overlooked. A lot of the sponsors who used to own a lot and be focused on New York, New Jersey, Connecticut are now focused on the Southeast. The reality is I'm just focused on New Jersey because it's just a good example market. We're looking at deals in Atlanta as well, by the way, despite everything I just said. New Jersey is one of these markets where insurance is vanilla, tax reassessments are vanilla. It's a tiny state. The GDP is massive. The affluence is massive. It's difficult to build, so you have a supply constraint. You have an educated, wealthy renter pool. And most people are not looking at deals there because it's stigmatized, right? Yeah. It has this stigma of being a blue state and of like affordable housing restrictions and rental restrictions, et cetera. But the reality is that's not the truth on every deal in Jersey. That's the truth on some deals, but not every one of them. So we're contrarian investors. We like to go where other people are not going.
Well, it's like I've always said, you want to go where the money, you don't want to go where the money is. You want to go where the money's going to be.
That's right.
All right. And so, that's interesting that you're investing in some of those, not states that I wouldn't necessarily think, to even look at.
Right.
And what's if when you're underwriting a deal, when you're kind of going through the early stages, what is it that you're looking for in a deal that gives you tips you off? Hey, this could be a good one.
If I can simplify a pretty loaded question, right? I'd simplify it to three sort of variables. The first is the going in cap rate. So if you've listened to podcasts with me before, which sounds like you have, I've been talking about this a lot, which is neutral to positive leverage. So most people don't know what that is. What that is where your cap rate matches or exceeds your borrowing interest rate. So if I can borrow at 5.5%, I need to ensure for a prudent investment that my going in cap rate, NOI divided by purchase price for those who don't know, equals or exceeds my interest rate. That means that I'm making more yields than my lender is. And it also tells me that I have a healthy cash flow. I'm getting it at a good basis. That's the first variable. The second variable I look for is not to bank on rental growth, but rather capturing loss to lease. Loss to lease is where my property is charging $1,800 for a 2-bedroom and the property next door is charging $2,100. So I have a loss to lease of $300. So how do I capture that loss to lease? Is it because of mismanagement by the seller? Is it because there's necessary CapEx or renovation dollars that the seller just doesn't have the capacity to spend in order to justify increasing rents by $300, to stick with that same example? How do I capture it? So once I figure out if there's a game plan or ability to capture that, okay, now I'm not banking on rental growth. I have a good going in cap rate. I'm banking on capturing money that's being left on the table. And then lastly, what's my exit cap rate? That's probably the most powerful lever in any underwriting to determine whether or not it's conservatively underwritten or not. We're not underwriting deals with a 6 cap on exit right now, especially in multifamily, even though most institutional groups want to see that. I think they're being overly conservative and subconsciously cutting themselves out from the market, from participating in the market when they want to see that on an exit cap. The reason is nobody believes that between now and the next 5 years, interest rates are going to stay at 6%. If we're going with that rule of neutral to positive leverage based on cap rates, most foresee, if you look at the SOFR forward-looking curve, interest rates of the Fed or overnight rate coming down by 100 basis points. So that would mean in the next year or 2 years, rates are in the 4.5% range. So why would I underwrite an exit cap of 6%? More conservative would be maybe 5.25%, 5.5%, maybe 5%. So that's the other place. That's the third variable, I would say, as far as what we're looking for to make the deal work.
Yeah. And by the way, that's a really, I think, holistic approach to looking at it, right? You're looking like beginning, middle, end, right? Like, what do things look like right now? What are things going to look like in the middle? What are things going to look like in the end? And how are those variables going to impact the vitality of the deal? So that makes a lot of sense to me, Julian. Well, listen, I know that we're coming up on time for you, and I want to be respectful of your time. So 2 final things for you here. If anyone wants to get a hold of you, they're interested in maybe investing with you, Julian, obviously we're going to put the links down in the description box below, but where can they find you?
www.colonyhillscapital.com. Hills is plural. And our website has all sorts of calls to action to register or meet with us. Probably a dozen places on the landing page for you to get a hold of us.
All right. So you can't miss it. Yeah. You can go to colonyhillscapital.com and you will know how to get in touch.
That's right.
with Julian. Love it, man. Well, listen, in traditional Gould Mine fashion, would love for you to leave the audience with one final Gould nugget.
I would say this is for life and for business in general. Stay present. Don't get caught up on what you want or what the future is going to be, what you think the future is going to be. Be where you are. Enjoy your life. Life is short. Stay present. That's my nugget.
Love it, man. Well, I appreciate you coming on the show, and thanks so much for stopping by.
Thanks for having me.